The most important, the most interesting event for most investors in February is the annual letter to shareholders of Warren Buffett. But he did not start this tradition with Berkshire Hathaway. Now they are called the Berkshire Hathaway letters to shareholders. There are books about this, and I have the book. But he used to write letters to his partners when he used to manage the Buffett Partnerships. That was in the late 1950s and 1960s. At the time, Warren Buffett was still under 40, and if you look at the returns that he was making, today the average returns of Berkshire Hathaway over the last 55 years is 20.0% compared to 10% for the S&P 500. That's why Warren Buffett is so rich. You may say it's only a 10% difference a year, but because of compounding, because of compound interest over the long term, it makes a big difference. That's why Warren Buffett is the greatest investor in the world today. And if he did not donate all that money, he would be the richest man in the world. But if you look at the returns before Berkshire Hathaway, you look at his partnership returns, they are better than the Berkshire Hathaway ones. There are multiple reasons why this is the case. Number one reason is because when you're managing more money, it becomes harder for you to actually make good returns. So today I want to talk about these first letters of Warren Buffett, the partnership letters. What did he write about? What were his strategies back then? And how was he able to make so much money in 13 years? The Buffett partnerships lasted 13 years. We are also going to talk about why he eventually abandoned the partnership. Before we go into details and talk about all of this, please make sure to smash the like button for the YouTube algorithm. If you're new to the channel, my name is Ishfaaq. I am an elite popular investor on eToro. So please make sure to subscribe and hit the notification bell so that you don't miss the coming videos. Let's talk a little about history. Warren Buffett. He's 26 years old. He already finished college. Now he wants to be a full-time investor. This is something he always wanted to do. He was very good in numbers. So he found some family friends and asked them some money for him to invest for them. It was not much at the time. These family friends were quite rich. It was a total of 105,000 US dollars. 105,100 US dollars. That 100 US dollars that was from him. But eventually, of course, as he was getting paid from these partners, he was reinvesting in the partnership. So eventually his skin in the game was increasing. So you don't say that he only invested $100. But that partnership lasted for 13 years. And after 13 years, they had over 100 million US dollars in assets under management. And that's when he decided to close the partnership after 13 years. So in those 13 years, the average return for the partnership was 31.6%. That was much better than the average market returns. And you also need to understand that in these 13 years, there were years that the market crashed, but the partnership never crashed. So what was his strategy? How was he able to maintain such a good partnership that even when the market is crashing, the partnership returns are positive? The number one thing we need to talk about is deep value investing. Today, Warren Buffett is a value investor, but at the time he was a deep value investor. What we will call today deep value investor. Maybe if you're going to read what he was writing, if you're going to read security analysis or everything else that Benjamin Graham wrote about, he will still call it value investing. But actually today we call it deep value investing. So Warren Buffett, he was not really looking at the businesses like he does today. He did not meet Charlie Munger yet. He was more focused on numbers. So there is a business, it doesn't really matter if that is a good business or not. If let's say the business has a good balance sheet, there is a high probability that if let's say the market doesn't really like this business right now, there is a high probability that eventually the market will realize its mistake and he will make profits on that. There were many companies that had a portfolio of stocks. So they were holding stocks and he was buying those stocks at a discount by buying the shares of the parent company. For example, this is the same thing you may say I'm doing with Genworth Financial, because they have a portfolio of bonds, and today I'm buying Genworth Financial, 15 billion US dollars in tangible book value. I'm buying at a little over 2 billion US dollars the market price. So you're buying a company at a discount. This is deep value investing. It is based mostly on the balance sheet. I made a video recently about that. You can watch that video. Only later, Warren Buffett changed his strategy, focused more on earnings, and that's after meeting Charlie Munger, and that mostly for Berkshire Hathaway. Why he had to change this strategy is not because the first one was not working, it's because he had more money to invest. When you have $100,000 to invest, and most probably you're watching this video, you have less than $100,000 to invest, or even less than $2 million. I don't know how much money you have, but I'm pretty sure you don't have $100 million to invest right now. So if you have, I'm very happy for you. Well done. But if let's say you don't have that much money, it is better than to invest in devalue companies, because this is where most of the returns are. My best investment ever, GameStop. This is this was a devalued stock when I made the investment. So only when your assets under management is growing and you cannot invest in those smaller devalued stocks anymore, that you look for value stocks. For example, Warren Buffett with over 900 billion US dollars in asset under management, he cannot invest in a $1 billion company. If let's say he buys 10% of a $1 billion company, that's 100 million US dollars. 100 million US dollars out of 900 billion, that's nothing. So it's not going to make any difference to his portfolio. So what's the use of investing in it? You want to invest in a company where it makes a difference to your portfolio. I invested 8% of my portfolio in GameStop. But if let's say I had 100 billion US dollars, even if I bought the whole company, it would have been only 0.4% of my portfolio. So it would not make any effect on my portfolio. So then when you grow as an investor, you have more money to invest. What you have to do is that you have to look for bigger deals. But when you look for bigger deals or bigger companies, you don't find the deep value ones anymore. So you have to go to value investing, because bigger companies are followed by more analysts. So you change your strategy, you look more towards earnings rather than the balance sheet. But for his first 13 years as an investor, this was his strategy, deep value investing. He was not really looking at earnings. And he made several good acquisitions at the time. And there were three types of deals that he was making in the market. The first one were generals. And this is the one that we are most familiar with. We are investing in a company. This is what I do most of the time. We are investing in a company. We don't want to own the company at 10%. We own only a few shares and eventually we take profits. For example, Warren Buffett invested in Apple. He owns 5% of Apple. Eventually, maybe he will want to take profits when Apple gets expensive. We don't know if he will do this or not. This is a general investment, what he used to call it in those letters. The second type of investments are controls. This is activism. This is mostly not really done by Warren Buffett today. And another reason is because of his big portfolio. So what is activist investing? You invest in the company and you try to change things in the company. You try to influence the management. One example is Berkshire Hathaway. Warren Buffett invested in Berkshire Hathaway. It was a sort of activism, because as soon as he invested in the company, he fired the CEO. He got into a fight with the CEO and he always said this is one of his worst investments ever, and I understand him. You should not put your emotions into your investments. But what is done is done. Now Berkshire Hathaway, the largest company in the world by book value. For you to follow the steps of Warren Buffett to do activism, it's not that easy. You need to have a lot of money. He started with 100,000 US dollars, eventually grew to 100 million. But still, at the time, that was a lot of money. And if you are going to do activism with not so much money, even back then, it was not so much money. You have to do it with very small companies. So I'm not saying that it is hard to do, but on your own, it is hard. Of course, you will need bankers, investment bankers, you need lawyers to help you in all of that. Warren Buffett was smart, he did not really need these people. But if you are going to do activism, because normally you are going to change the business, let's say you are doing activism, you just want to liquidate a company. This is something you can do. But how do you liquidate then? How do you know at what price are you going to sell all these assets? You need someone at least that knows how to do liquidation. There are investment bankers that are specialized in liquidation, auction and liquidation. You can ask for their help. Or if you are smart enough, you can do it yourself. So it's not something easy to do. And especially today, you need a lot of money to do it, at least money from other people. And one example of activism, again, my investments in GameStop, for me, that were general investments. But for Ryan Cohen, for those two hedge funds that had a proxy fight about GameStop, For them, that was activism. And finally, the third type of investment Warren Buffett was making, were workouts. And I have talked about workouts. This is once again companies going through some corporate action, but you don't force the corporate action. With control, you force the corporate action. You force them to pay dividends. You force them to buy back shares. You force them to do something. But with workouts, they are already doing it. You are just here to collect your profits. One example of workout is arbitrage. So what is arbitrage? A company is acquiring another one, so there is a price at which they are acquiring, and you buy that acquiry at a lower price. Eventually, you take profits when the deal goes through. This is arbitrage. Warren Buffett was doing a lot of arbitrage. And actually, about 25% of his portfolio was in workouts. So he was doing a lot of these workouts. Even today, he still does workouts. For example, he invested in Red Hat when it was acquired by IBM. He invested in Monsanto when it was acquired by Bayer. So all of these are workouts today, but of course, it's not the same extent as he was doing back then, 60 years ago, because back then he had less money to manage and it was easier for him to do all of this. This is something you should certainly consider. Why you should consider this? Because Warren Buffett, how was he being paid? He became rich through this partnership even before he invested in Berkshire Hathaway. But how was he being paid? You need to understand the fee structure of the partnership. He was not taking management fees. Okay, that's not usual. Usually hedge funds take management fees. He was not taking management fees, and he was paying his partner 4% per year. So let's say you invest in the partnership $100,000, you're sure to make $4,000 after 1 year. It doesn't matter how much the portfolio returns. If you have $100,000, you are sure to make $4,000. So how was he able to ensure that this will happen? Because if let's say the market does bad or the portfolio itself does bad, then how is he going to pay all these people? That's why he was making use of arbitrage. That was him not making use of workouts, because in workouts you have more control. The probability of losing money over a certain amount of time is not that high. That's why he was able to pay these people 4% a year. That was the guarantee. Now you may be asking, how does Warren Buffett make profits? He was making profits by beating the market. Yes, that's usual. But he had another rule. If he was going to beat the market by more than 5% on a particular year, let's say he beats the market by 10%, then half of the profits goes to the partners, half of the profits goes to him, the general partner. That's how he was able to make so much money. So let's say there is a year the portfolio did not do so well. It did not happen, but let's say there was a year when the portfolio returned only 2%. So if you have $100,000 invested in that portfolio and the market that year beat the portfolio, even if the portfolio returned only $2,000, you are guaranteed to have $4,000 because there is that 4% guarantee. So that was a year if the portfolio did not do well. And I told you in 13 years, it did not happen once. Now there is a year that the portfolio did very well, beat the market. Let's say market returns that year were 10%. The portfolio returned 20%, so 10% more than the market. And as I told you, 5% goes to Warren Buffett and 5% comes to you. So 5% after the initial market profits. So the profits from $100, $10,000, that market profit, it goes to you, plus you have $5,000 more. So in total, if you had invested in that portfolio, even though the portfolio returned from that $100,000, the portfolio brought it to $120,000, you take only $15,000 home. $5,000 goes to Warren Buffett. So he's been paid a lot. That's how he was able to be so rich. He's been paid a lot. He's a great businessman. He was a great businessman even back then. But he only makes these huge profits if he can deliver huge profits to you. Of course, your profits are going to be less. Your profits are still going to be much bigger than the market, and there is very low risk for you to actually lose money. But if he beats the market by a large margin, he's taking a lot of money home. So that's why he was able to make so much money by managing the partnership. So what happened then after 13 years? Why did he close the partnership? It's because the market was at all-time high and deals were very rare. He had too much money to invest, $100 million, and it was better for him to just close the partnership. because if you have so much money and you cannot find investments, there's nothing you can do. But luckily for him, he met Charlie Munger later, and he told the partners, if you want to continue to follow me, I'm going to invest in a company called Berkshire Hathaway. It was one of their controls, so he invested most of the money from the partnership in that company, Berkshire Hathaway. And the partners, some of them followed him. Others, they took their money and had a party. And but those that followed him, they are the ones that today are very rich. So let me know in the comments if you have any questions regarding the past letters of Berkshire Hathaway, of Warren Buffett actually. I'm going to talk more about these letters. Thank you for watching this video. Please like, subscribe, and share. Please watch these two videos if you have missed them. Have a nice day and goodbye.